wanting to say something.
Ladies and gentlemen, welcome to the live stream. Tevis isn't in the best connection area anyways, but that's not a problem at all, okay? The real person that we're trying to listen to is Chris Lapointe at the UBS Financial Services Conference. That call, obviously, like you can see down below, will start in just the next 9 or so minutes. But until then, Tevis, what do you want them to address?
Yeah, so first of all, I want to address the obvious. My clothes were packed and I don't have sleeves. So we're getting comfortable on this pod. I think, with regards to Chris Lapointe, the last fireside chat that he had was really crucial towards understanding loan sales. And then the one before that was really crucial to understanding the stock-based compensation and the PSU award structure in general. Yeah. This time around, I am looking for more confirmation around, maybe updates on that guidance and the macro implications of that guidance that they provided, because I think that's what the street is going to be looking towards. The street, the biggest bear case for SoFi from an analyst perspective, and I mean, we all know that they're going to find one, is, sorry, I'm reading the comments, is that the lending segment is going to be flat to down. And we know, after having done some due diligence, that this implies a very rough macro environment, which if it pans out that it's actually smoother than we expect, then probably we're not going to have as big of a implication on the lending segment being down. And so for Anthony, or for Chris Lapointe today, I mainly want him to address some of those outstanding questions and put the market's mind at ease, just to provide some more guidance in terms of what he's seeing out there with regards to loan sales, with regards to the lending segment in general, and just, how much of a skew did we get from the guidance that SoFi provided, last couple of weeks to today, and what is that Q1 looking like? I'm going to stop now because I got to read these comments.
Yeah, I mean, so just for the people that don't follow SoFi as closely, after they reported earnings in Q4, they still have not released the 10K for the business. So, some of the analysts might not be having the most up-to-date information as what they'd want to by now. Hopefully, maybe coming with this presentation is the release of those. It should be around this time. I mean, we're kind of a little bit late now, but that doesn't matter. So some of the clarity on the lending numbers is exactly all I'm looking for. Maybe some more chats about their expectations for 2026. This was something that, Anthony Noto and team kind of brushed by and analysts really stuck onto, right? Because guidance is everything for them, future growth. If you actually look at where guidance is for SoFi's perspective, they're asking for like 55 cents of EPS to 80 cents EPS in 2026. Currently, analysts across the board averaged out are saying they're going to come in at 52 cents for 2026, so under their estimates. So that's going to probably be a big topic of conversation, is just where'd you get these numbers and how do you plan on achieving them? A little bit more clarification there might lead to potential upside from, analyst upgrades or revisions from that point. But
yeah, so in terms of the actual format, Tanner, I'm curious to hear what you think. Do you expect it to be like previous firesides where it's just a period of prepared remarks followed by a period of questions, or do you expect it to be a little bit of variance?
Yeah, I mean, this is not a SoFi direct conversation. They're doing a bunch of different companies at this large conference. So I think you're going to hear Chris Lapointe come in, say what SoFi does, how they plan to differentiate, maybe a couple of other prepared remarks. But yeah, I think it's going to be very standard. This isn't a SoFi specific thing like the investor Q&A was or something like that. So, but still, there's always sometimes where these, whether it's Chris Lapointe or Anthony Noto, they both like to throw in some nuggets of gold within these chats. So I'm still looking forward to it. Right now, they have a time slot of an hour. Fireside chats can sometimes be less than a half hour. So if we get the full hour, I'd be really excited. But yeah, we'll see. Tanner needs some sun. I do. It's winter. I'm in Canada. I got vitamin D.
So Matt Money, who's in the chat, posted earlier today, and who is also a recent SoFi investor, and apparently our lucky charm because he bought like 3 minutes before the close on Friday, and we're up today. He posted, when are we going to have SoFi Con, basically a yearly convention for SoFi. My vote is that we have it in Mexico or some other tropical climate. Everybody in the chat is more than invited. So Tanner, can you commit on stream so that if SoFi hits a certain dollar value, that you will join us at SoFi Con at an all-inclusive resort in Mexico?
Yeah, I mean, SoFi Con, I'm gonna have to show up to, right? I'll come to Mexico for SoFi Con. What's the price? When does that happen?
So I was going to ask you that. What is the price, Tanner? Is it 15? Is it 20? When do you feel comfortable with that new house to put some aside and come drink tequila with us?
So, I mean, SoFi stock has already been at $20, $15. I want to see something it hasn't hit before. You know, if SoFi hits $30, I'll come out.
Bro, if SoFi hits $30, we're all going to Dubai. I'm sorry to tell you. we gotta make tiers like the management team has PSU tranches. We gotta say, okay, $20 Mexico, $30 Dubai, $40, wherever. And then this applies for the chat as well. I mean, you guys are going to be making just as much bank as we are on this. I'm personally going to be inviting Anthony Noto and Chris Lapointe out here as well. So Matt Money's going to be here. Tanner's going to be here. So you guys, I'm telling you, SoFiCon, we have to make it happen.
So someone said, have it in the tranches that, Anthony Noto has his stock shares at. I think that's appropriate. Yeah, no, I would love that. I'd love that. I know there's all this questions because I didn't go to Vegas. It's like I'm not opposed to going and see you guys. I already saw you in real life. You and Riley all met up.
Yeah, we did. That was fun. We got to get Steven out here too. I feel like he's going to be the hard one to convince.
That's the real question. Will Riley show up to SoFiCon?
You'll have to show up to find out.
Yeah. So, it's starting up. The music has stopped. Now I'm hearing them set up the mics and stuff. Hasn't actually started for sure, but they're just preparing right now. I'll keep that up. The second I start hearing some voices, we'll switch over. But yeah. How is Riley though? I think he's on some sort of meditation retreat thing or whatever. He'll be back in April. Danny Deals needs to come. Oh, starting up.
In Miami. I'm Tim Chioda. I'm the lead payments, processors, and fintech analyst here at UBS. And I'm joined by my colleague, Jill Shea. Jill Shea is a U.S. consumer finance analyst. Jill, thanks for being here.
Thank you.
And of course, we are both happy to be hosting the CFO of SoFi, Chris Lapointe. So we have a great set of questions here to go through with Chris. We're going to start with a little bit of recapping some of the recent financial guidance that was given, both for the coming year and for the medium term. We'll get into a little bit the origination trends and the lending segment before moving on to financial services, technology platform, and then potentially a few miscellaneous questions at the end, time permitting. So with that, Chris, and to the whole SoFi team, thank you for being here today.
Thanks for having us. Really appreciate it.
Okay, as we mentioned, we're going to start by talking a little bit about the outlook recently provided by SoFi. So we'll start with the top line, and then we'll move on to margins in a little bit. But for the top line, so 2024, really fast growth in tech platform and financial services, but a slight slowdown in lending. Maybe just talk a little bit about this year's growth and then that reacceleration or the 3-year CAGR.
Yeah, absolutely. So in terms of 2024, it's going to be a transitional year for us at SoFi, where the vast preponderance of the growth is going to come from our tech platform and financial services businesses collectively. they're going to grow at about 50% year over year and are going to comprise about 50% of the overall revenue pie in 2024 for the full year. And that's up from about 38% in 2023. In terms of the growth by segment, financial services, we're expecting to grow about 75% in 2024. Our tech platform is going to grow about 20%. In our lending business, we are taking more of a conservative approach given the macro uncertainty with respect to rates, as well as liquidity concerns across the broader industry. In terms of the outlook for 2023 to 2026, we are expecting compounded growth of 20 to 25% across the entire business. Financial services is going to grow about 50% on a compounded basis, and that's going to be driven by continued growth in our deposit franchise, as well as corresponding net interest income. We're also going to see continued growth and acceleration in overall spend and interchange revenue. We saw really good momentum over the course of the last several quarters, whereby in Q3 of 2023, we had about $1.2 billion of spend. In Q4, that accelerated to $1.5 billion of spend, or $6 billion of annualized spend. And in 2024 Q1, we're seeing another acceleration, and we could expect to see double-digit percentage sequential growth in the overall debit spend on the platform. So we're expecting to see continued momentum in that business. We're also expecting to see further monetization in our invest business. We rolled out options and margins last year. We just rolled out mutual funds and alts as well. And the IPO market is starting to become more favorable, and we're really pleased with the pipeline that we have there with potential customers. And then on the lending as a service business, that's been a nice grower for us, high margin business, and that will continue to show really good momentum in 2024 and throughout 25 and 26, especially as we are taking a bit more of a conservative approach on our unsecured personal loans. In terms of the tech platform, that growth is going to be driven, it's going to be about 25% compounded growth over the course of the next 3 years. That's going to be driven by continued momentum of existing customers, as well as new customers that we are starting to sign up. And as a reminder, we've shifted our overall strategy to focus on more durable revenue and diversified revenue streams by talking with and providing solutions for larger financial institutions, larger brand names with big installed bases, et cetera. And then lending, we are taking more of a conservative approach in 2024, where revenue is going to be about 92 to 95% of 2023 revenue. Our personal loans originations will be flat to down. Student loan refinancing will grow modestly, and home loans will grow correlated with rates. But in 25 and 26, once we get more visibility into the macro and hopefully rates stabilize a bit, we'll be beyond a presidential election. We would expect to see an acceleration in growth in lending. But overall, 20 to 25% compounded growth across the entire business, fueled by growth in tech platform and financial services.
Chris, thank you for that excellent recap. I think we covered top line quite well. Let's move on to margins. So you mentioned expecting to exit this year, 2024, with roughly 30% EBITDA margins. And generally, in the past, you've talked about the business operating at roughly a 30% incremental EBITDA margin target as the way you look to manage the business. Maybe just talk about what that means for margins this year and over that 3-year period.
Yeah, so in terms of overall margins, we've done a really nice job of dropping more to the bottom line over the course of the last several quarters. We had higher pull-through at over 40% incremental adjusted EBITDA margins. That's been driven by a few factors. First is top-line revenue growth outpaced expectations. Second is the average revenue per member has exceeded our expectations. And then third is we are seeing really good leverage across each and every one of our functional expense lines. Specifically speaking, if you're to look at our sales and marketing as a percentage of revenue and look at 2023 versus 2022, we saw a few hundred basis points of overall margin improvement. And that was a function of a number of things. First, brand. We're making significant investments in brand and brand awareness. If you're to rewind back to when we started launching these financial services products back in 2019, our overall brand awareness was just 1 to 2%. So every time you ask 100 people, name 3 financial institutions, we would only come up 1 to 2 times. Fast forward to where we are today, we're now hitting, upper single digits on a consistent basis, which is quite phenomenal given, it's only been a few years. Now, we're not where we want to be yet, and the likes of JP Morgan and Bank of America and larger financial institutions are 30 to 40% unaided brand awareness. But we've done a really nice job of slowly and steadily growing that unaided brand awareness over time. The second thing that's driving margin improvement is we're just getting better at targeting our potential members. That's obviously aided by the fact that our investments in brand are making those dollars work that much more efficiently. And then the third thing is we've been able to maintain really healthy levels of cross-buy. Right now, 30% of all products that are taken out are coming from existing members on the platform, where we don't have to pay a second customer acquisition cost. So those 3 factors combined are what's really driving the operating leverage that we're seeing in sales and marketing. We're seeing really good operating leverage across the other lines as well. Research and development as a percentage of revenue was down 100 basis points year over year. That was a function of the migration from being on-prem in the cloud for Galileo. Our operations expense line is about 200 basis points better than what it was in 2022. That's a function of starting to realize the benefits of the investments that we've made in automating our onboarding funnels and other tools and resources. And then our G&A has improved by 800 basis points year over year. And that's a function of the leverage that we're seeing in stock-based compensation, but also a function of the investments that we've made over the course of the last several years in preparing to become a bank and a public company. And we haven't had to grow headcount meaningfully over the course of 2023. So looking forward, you can expect to see continued leverage across all of those functional expense lines. Sales and marketing specifically, you could expect to see modest growth in dollar terms in 2024, which is kind of in line with the current rhetoric around the cautious approach we're taking to lending.
Chris, thank you. And points well taken on the sales and marketing with the unaided brand awareness helping the performance marketing and also the cross-buy chipping in. So a lot of things moving in the right direction. Thank you. With that, I'm going to pass it to my colleague Jill, and we'll begin the discussion around loan origination trends.
Yeah, so thank you. So in terms of loan originations, you touched on it a little bit already, but personal loan originations flat to down into this year, student loans to grow modestly, and then the home loans, sort of correlated with rates. In terms of that growth, you mentioned that you're limiting growth just given the macro. Is there appetite to throttle that up or down depending on your comfort level with the macro picture, or do you plan to hold tight to that slower pace of origination growth?
Yeah, what I would say is when we provided that guidance during the earnings call, it was based on the best information that we had at the time and our view on the broader macro. I think looking forward, I think an awful lot would have to change for us to take a different stance on originations over the course of the next 12 months. There's still a ton of volatility with respect to rates. If rates do come down 4, 5, 6 times as expected, what does that actually mean and imply? Yes, it may be great for a refi business, but does that necessarily mean that the economy is doing well and we should accelerate lending? So we would have to evaluate at the given point in time, given all of the factors that are at play. But right now, a lot would have to change, and a lot more certainty with respect to the macro would have to change for us to get comfortable.
Okay.
But I mean, the only other thing I would say there is, we are able to operate very nimbly and allocate capital as necessary to maximize shareholder value and the return on those invested dollars. So similar to what we've done in different rate environments over the course of the last 5, 6 years, we can act nimbly if the option presents itself and deploy capital appropriately.
Okay, that makes sense. So maybe just in terms of balance sheet management and decisioning to grow the overall balance sheet size, can you just talk about growth of the balance sheet versus loan sales, securitizations, or utilizing your forward flow agreement? Should we think about the balance sheet as sort of flattish this year? And then maybe could you just talk about the investor appetite for loan sales?
Yeah, so I would say is the growth in the overall balance sheet is obviously a function of a number of things. It's based on the originations that we do, the sales that we do, the pay downs or amortization of those loans on the balance sheet. Given where we're sitting today and our posture on flat to down PL originations, modest growth in SLR and growth correlated with rates on the home loans business, coupled with the fact that we do have really robust demand from credit borrowers, more than we've seen over the course of the last few years. We expect a growth of the balance sheet to be relatively modest. I think from an investor perspective and how you can think about it is that the originations will grow roughly 15% or so over the course of the next few years. And the balance sheet will grow in the mid-teens level as well. So that's the best guardrail that we can provide at this time.
And then perhaps turning to the funding side of the equation, your total deposit growth was quite strong last year, up $11 billion, and your deposit growth continues to outpace your loan growth. Is that a trend that we should expect could continue? And is there targets you have in mind in terms of how much of the loan book you want funded by the deposit base? And then maybe a second piece of that would be just any tailwinds to the funding costs, just given the mix shift.
Yeah, what I would say in terms of the overall growth in the deposit franchise, we've had really good success since opening the bank of growing that at a pretty healthy clip. Over the course of the last 6 quarters, we've grown it by over $2 billion or so. And right now, the overall funding stack is that we're funding about 65% of our loans via our deposits. We do expect that trend to persist going forward of generating more than $2 billion of deposits for the foreseeable future. And, you know, there are a number of ways that we're going to be able to deploy those deposits. Right now, we have $6 billion of higher cost funding in the form of warehouse lines. We have about $3 billion of warehouse lines that are drawn today. And we also have brokered deposits that have a higher cost of funding as well. So we have about $6 billion of deposits, higher cost funding that can be displaced by these member deposits at a lower rate. In addition to that, we can deploy these deposits against other interest earning assets and other vehicles. We started doing senior secured loans, which generate a good return for us, and there are other avenues there. So we're not necessarily capped in terms of overall deposit growth, just by the consumer loans that we're originating.
And then perhaps drilling down into net interest income a bit more, very healthy trends there, and their NIM was up last year. Can you just talk about the NIM dynamics and the interest rate positioning of the balance sheet, just both in context of a Fed that's potentially cutting, as well as in context of if we get a higher for longer?
Yeah, so in terms of our overall NIM margins, they were 6% at the end of the year, and we've been really great about being able to expand our margins over the course of the last few years. If you look at 2022 versus 2021, we expanded our NIM margins by about 145 basis points. If you look at 23 versus 22, we expanded our NIM margins by about 44 basis points. So really good success in expanding those NIM margins, and that's a function of a few things. One is obviously the fast growth in our deposit base, and having a deposit beta that's less than 100%. And then second is having a loan pricing beta that's north of 100%. So looking forward, we do expect to be able to maintain very healthy NIM margins north of 5%. That's a function of being able to displace that $6 billion of higher funding, the higher funding stack that I just talked about. And that will offset some of the headwinds that we may face as a result of a declining rate environment, and still being able to maintain a higher APY for our deposit customers, as well as some of the headwinds that we may face as a result of a mix shift in the balance sheet towards lower yielding student loan refinancing assets. But net, we expect to be able to maintain really healthy margins north of 5%.
Great. And then maybe turning to credit quality, we're seeing delinquencies and charge-off rates normalizing back to pre-COVID levels. Can you just talk about the health of the consumer and your expectations for credit quality as we move forward?
Yeah, we've been pretty consistent in terms of messaging our overall expectations for losses over the course of the last several quarters. What we've said is that we expect losses to return to pre-pandemic levels And our posture and our stance remains the same. We expect to get back to 7 to 8% life of loan losses in the early to mid part of 2024. What gives us confidence in that level is that we have really good visibility, obviously, into our net charge-off levels and rates. And if you're to look at Q4, about 15% of our net charge-offs came from credits that we have taken out of proactively taken out of the system. And that represents about 3% of the overall unpaid principal balance of loans on the balance sheet. And that's expected to get down to under 1% by the end of this year. So it gives us a pretty good sense. In addition to that, we've made other credit cuts in Q4, as Anthony alluded to on the call, for a number of reasons, given our view on the macro. In terms of the specifics about, some of the credits that we've taken out historically that are embedded in that 15%, what I would say is we're pretty surgical in how we approach our overall cutting of credit. It could be based on industry information. It could be based on the channel with which we're acquiring those members or originating those loans. So there's not 1, 2, 3, 4 specific attributes that are unique to the credit that we have taken out. But more importantly, we've identified pockets of credit that weren't performing as well. And we're able to act nimbly and quickly and cut those credits out immediately, such that we don't have a runaway NCO rate.
And then maybe just touching on a piece that you just mentioned, you reduced your credit box. Can you just talk about what you've done there and how you think that plays forward?
Yeah, we've been originating loans since 2011, and we have a ton of experience. We're constantly iterating on our underwriting models. We're very surgical about how we're cutting credit based on channels, industry, other dynamics. We're on the 4th generation of our underwriting model right now and have done a really good job of getting to a place where we have great visibility into early stage delinquencies and losses, such that we can cut these credits out, similar to what we've done over the course of the last 12 to 18 months.
Okay. And then maybe lastly for me, just on capital, capital ratios improved quite meaningfully in the fourth quarter, given book value growth, loan sales, and some of your capital optimization efforts. Can you just talk about capital ratios and where you would expect to run in 2024 and 2025 in light of your balance sheet expectations?
Yeah, we've done a good job of managing the overall balance sheet from a capital ratio perspective. You saw that in Q4, where we had our first quarter since opening the bank, where we had an increase in our total risk-based capital. As you noted, it went from 14.5% to 15.3%. That was a function of the growth that we had in net income and tangible book value, as well as a few capital optimization trades that we put on. If you were to look forward over the course of 2024, what I would say is that we're going to maintain a risk-based capital ratio of north of 14%, and that's well north of the regulatory minimum of 10.5%. And north of where we could actually operate the business. But again, we're taking a more conservative view to underwriting, and there's more headroom beyond that 14% if we wanted.
Great, thank you. I'll turn it over to Tim.
All right, we're going to switch over to financial services. So the main topic there I want to dig into is direct deposit. So you recently said that more than 50% of newly funded accounts are setting up direct deposit, which is an impressive number. Could you talk about how do you make that happen? It's marketing, it's cross-buy. What are the things that you're doing to make that number as high as it is, and some of the things that you could do to maybe even take it higher?
Yeah, it comes back to some of the things I was talking about in terms of how we're generating that leverage. Part of it's overall brand awareness. That has improved quite drastically over the course of the last several years. We've made it a priority to get direct deposits in the door over the course of the last few years since opening the bank. So it's a top priority of ours. It's been aided by brand awareness. It's been aided by product differentiation. We offer an industry-leading APY at 4.6% if you do direct deposit with SoFi. We differentiate across a number of different vectors: fast selection, content, and convenience. We want to be the fastest place where you can come and open a checking or savings account. We want to be the fastest place where you can go pay a friend, the fastest place where you can do bill pay. and we want a product that works better when used together with other SoFi products. So that, coupled with the higher rate, is what's been really driving the overall growth in deposits. And then in addition to that, there are other features like $2 million of FDIC insurance that we offer to our members, which is higher than the normal $250,000. We ended up rolling out that feature within days of the Silicon Valley banking situation, which created a lot of loyalty and trust with our existing member base and helped continue to drive deposits for us every single quarter since. So we feel great about it, and that trend will persist.
Okay. All right, great. Thank you, Chris, on direct deposit. We're going to move to technology platforms. So I think a good place to start is just to hit on some of the household names that are already working with and have been working with Galileo or the tech platform for some time, just to bring it to life. Maybe if there are a few that you could share with the audience and what you're doing with them.
Yeah, what I would say is we've had really good growth in terms of end customers and customer accounts on the platform. We're at 145 million, and that's been growing quite consistently. We don't disclose, obviously, all of the customer names that we work with at Galileo for a whole host of reasons, whether that's competitive or desires of that customer. But what I would say is we've had great success over the course of the last several quarters, as we've mentioned, signing up a number of new customers. We did a large POC with a top 5 U.S. bank. We just signed up Experian, and that's progressing really nicely. So while I can't go through all of the customer lists, there are a few there for you to go with.
That's a good highlight. Thank you, Chris. Okay, let's talk a little bit about the issuer processing business. So historically, a little bit more debit, recently been talking a little bit about credit. Maybe just talk about those two, and then also just the product roadmap in general and all the expansion of capabilities within Galileo.
Yeah, what I would say is at the highest level, Galileo offers products across 3 areas: payments, banking, and lending. And more importantly, we offer managed services to our end customers that enable them to manage, host, and operate those services that we offer them. The way that we think about our overall product roadmap is in 3 dimensions. First, we look at the end customer segments that we're going after. Second is the geographies at which we're offering our products and solutions. And then third are the actual products themselves. Within the segment vertical, or the way we think about it, historically, we've gone after smaller fintechs and neobanks and had really good market share there. Given the recent acquisition of Technisys, we've shifted focus and we've gone upstream in terms of customers in order to create more durable and diversified revenue that will set us up for decades to come. So we're now focused on large U.S. financial institutions and banks. We're focused on large brands with large installed bases, and then established fintechs and neobanks. In terms of the overall geography, geography expansion is much more broad than just expanding to new markets. It's about creating products and solutions that are tailored and curated for the end users in a given specific geography. So we've done a really good job of creating those tailored solutions and services. And right now we're in the process of expanding in 17 different countries across North America and Canada, as well as South and Central America. Then from a product perspective, we've had really good success of rolling out new products and services. We recently launched our payment risk platform, which enables end users and B2B customers to plug into our APIs and manage risk of payments. We recently launched Smart Data, which is a service that leverages MasterCard's very robust global data set and provides unique insights to our end customers. And then we also offered a corporate credit solution, which is a service that enables our end customers or B2B customers to manage expenses more efficiently. So overall, really good product roadmap, in great dialogue with customers across all of those segments, and we couldn't be more excited about the pipeline.
Excellent, Chris. Let's hit on one of those that you mentioned, which is on the traditional financial institutions. One of your competitors made similar comments. We totally appreciate that sometimes the roadmap or the timed implementation or RFP processes can be longer for those traditional banks. But what are the traditional banks coming to you for?
So the traditional banks are coming to us for a number of different reasons. They're coming to us, historically, we weren't even in those conversations because we were purely doing debit processing and API calls with our Galileo business. Once we got the Technisys, once we acquired the Technisys business and everything that's happening with the broader banking ecosystem, people have a need and a desire to modernize their tech stack. And replace their existing cores and have them such that they're extensible and customizable across their entire product suite. So right now we have folks coming to us who want to do core migration across all of their products. You have large financial institutions who have a different core for every single product that they offer. They have different mobile applications, et cetera, which makes it really hard, obviously, to target customers and to have all of your databases talking to one another and serve the customer in the way that they should be served. So we have a lot of banks coming to us saying that they, as a result of the fragmented core stack that they have, as well as the push from regulators who are forcing people to modernize their tech stack and have much more real-time visibility into both the assets and liabilities on their balance sheet, wanting to come to us and use our solutions. Now that, in addition to that, they're coming to us for traditional debit processing as well, because we are now cloud-based, it's scalable, and we can offer a comprehensive set of solutions that can live with them beyond just debit processing and into other products and services. So it's kind of a mixed bag of what they're coming to us for, but it's a combination of debit processing as well as full core migration.
Okay, excellent. Yeah, that was one thing I wanted to clarify, but it seems like you tackled that in terms of it's not just an add-on core, and many times it's literally migrating off of a legacy or alternative provider that's been there for years.
Exactly. It's a legacy provider that's been there for years or a homegrown solution that they have. And oftentimes we'll come in and we have to obviously prove out our value. We may start on one product or one service or start with new customers for a specific set of products. And then over time, we would migrate the entire core into one. But yeah, it's a mix across the various customers that we're talking to.
Okay. Thank you, Chris. Let's talk about another type of customer for the technology platform that maybe gets less discussion, but platforms, meaning marketplaces or point of sale systems, they have needs in terms of card issuance as well. Could you talk about either naming or not naming the names of those customers, but the types of services you're providing for them?
Yeah, it's kind of a mixed bag. We aren't disclosing, obviously, any of the customer names, but like I said, we have products across lending, payments, and banking, and the types of products and services that they're coming to us for span the gamut of those three verticals. They come to us for managed services, et cetera. You have large technology companies, large brand name customers who are looking to roll out a debit processing business or a rewards program, and they need our debit processing capabilities. So again, it's kind of a mixed bag across the types of offerings that we're able to go to market with. But the good news is we have the Galileo business, which is rooted in the debit processing and API calls. And now we have this core infrastructure that we can go to market on a joint product offering to these customers to offer them solutions that are curated and tailored to their needs at any given point in time.
Okay, so this, I think, last one here on tech platform. So RFPs, what percentage of these wins do you think involve a formal RFP process? And then the common question we get is who do you see also as a part of those most often, your competitors?
Yeah, I would say the vast majority of the deals that we're winning today have an RFP process, given the size and scale of the customers and the products and the services that we are offering. In terms of who we're seeing in RFPs, it depends on the product and the offering. You have, the legacy incumbents who, are on their first, second, third generation of modernized cores. So we see them oftentimes. We aren't seeing a lot of the pure digital processing businesses in RFPs. It's more of the legacy incumbents, or we're displacing existing homegrown technologies.
Okay, thank you, Chris. All right, well, it looks like we have a few minutes left, so I'm going to, Joe, I'll work in one of these and then maybe pass to you for one more of the additional. But one question we get often, and this is not just on SoFi, but across other companies that we cover, how should investors be thinking about the tax rate once we get to 2026, 2027? What are some of the things that might change there, and how should we be modeling that?
Yeah, what I would say is for 2024, what you could assume is that we still have a pretty large balance of net operating losses that have been built up over the course of the last several years. So until we release those NOLs, you could expect a tax rate that's at or near 0%. Going forward, once those are released, you could expect more of a normalized corporate tax rate consistent with everyone else.
Okay, but through the 2026 period, it still should be in the zero.
Through 2024 is where you could expect a low tax rate, and then beyond that,
24. Okay, thank you.
So maybe just looking at your 3-year anniversary of owning a bank charter since early 2021, can you just update us on the benefits you've achieved with the bank charter and how they translate into increased profitability for SoFi?
Yeah, there are a ton of them. It was one of the best strategic decisions that we obviously made as a company, because it's providing us with a really sticky source of low-cost funding for our loans business. I couldn't imagine going through the cycle that we've gone through over the course of the last 18 months with the rate volatility that has happened and the overall credit market without having this low-cost source of funding. So right now we've got just south of $19 billion of deposits. These deposits, have a cost of funding that's about 200 basis points less than our next alternative source of funding. So take, for instance, in a scenario where we didn't have a bank and we had to rely on that next alternative source of funding, 200 basis points is $20 million on every single $1 billion of loans that you're originating. And we have, $20 billion of loans on the balance sheet today. So the numbers start adding up in terms of the overall savings that we've been able to actually realize as a result of having the bank charter. So we are thrilled with getting the bank charter. We still have a lot of room to grow in terms of deposits in order to displace that higher cost funding, warehouse lines, as well as brokered CDs. But we couldn't be more pleased with the progress that we've made with having the bank. It's opened up a ton of doors for us, both from a cost perspective, but also in additional products and services that we can offer to our members, and then in the future, other end customers.
Well, to Chris and the full SoFi team that made the trip down to Miami, we really are glad to have you here, and we appreciate you being on stage with us. Thank you, Chris.
Thanks, Tim.
Thank you.
I mean, wow, that's what I wanted. A lot of talk about the tech platform, and from someone like, I'm not going to try to discredit Chris Lapointe, but it's not necessarily where he's focused. So even him giving all of these breakdowns, top 5 US bank, by the way, that has not been said before. So holy, like what are the top US banks? I think it's JP Morgan, Bank of America, Citi, Wells Fargo. And what's the 5th?
US Bank. US Bank.
US Bank. I'll make a little bet that it's Citi. I think it's Citi, because I remember Technisys had a little deal with Citi back in LATAM. So maybe this expansion with Galileo is just a furthering of that. And it doesn't necessarily mean that we won it, but it's definitely a great sign. I thought it was a smaller company than that.
Yeah, the thing that I sort of picked up is that he used the past tense. We did a POC, which implies that the POC is already completed, that it's done. and that it's been validated. It's not like still in progress. Which is why in my mind, I said, okay, well, now that you've completed the POC, when are the accounts going to migrate over? Because if he had said, hey, we're still in progress on a POC or we're working with, but he said, no, we completed this.
Yeah. Yeah. Well, completed it successfully. I'm going to assume that if they brought it up that it was successful, but yeah, I mean that's what leads to that 20 to 25% CAGR through 2026.
It's really interesting. Like, I'm just putting together some of the pieces where as soon as they reported profitability on the earnings call for profitability, on the retail shareholder Q&A, I want to say in December, and now on this again, people have been asking them essentially to name drop their clients. So it's been like more consistently people have been asking them to name drop, whereas in 2023, nobody was really asking them like, hey, can you actually like tell us who it is?
Yeah. Yeah. No, like I said, it might
Plus,
not even be just their rules. It might be, things that the clients are setting out to have a continued competitive advantage, saying, hey, don't give away our services.
Well, two things I'll say. Number one, with regards to the POC being completed or not, I think the competition that SoFi is against with regards to, okay, are we going to make a cost benefit analysis to move over to Galileo, or are we going to stay with what we currently have? The competition is the existing paradigm, right? It's the existing, a lot of times it's the in-house solutions that they want to move from. Sometimes it might be regulatory that they need to eventually move from. And so I think that it's not as though Galileo is in this perfectly competitive market where it's them against 20 competitors. And then these large legacy financial institutions have their pick of the litter of who they want to go to. There's not a lot of options. So either you go with Galileo, which is this out of the box solution, or you stay with whatever you have already, which you acknowledge it's broken. Otherwise, you wouldn't have done a POC in the first place. And so that gives me confidence that the POC would have been successful just because of like the landscape that we're in with Galileo. The second thing I wanted to point out is, I've seen this in my day job consistently where, I'm working in product development at a startup company, and we are in a competitive market it's a B2B SaaS company, right? So we're selling software. The logos that we put up on our marketing site, those are the clients that everybody else poaches from us, actively calls those logos and says, hey, are you satisfied with so on and so forth? We'll give you a discount. We'll go 50% off, just so that we take those logos off of our site. And so that came to my mind when Chris Lapointe touched on, oh, well, it's competitive, it's competition, it's all of these other reasons. And I thought to myself, oh, that's interesting, because whoever they name drop is like, hey, let's just say we're working with Citi, then whoever the competitor is or whoever wants to take some share away from SoFi is going to go to Citi first, because that's a confirmation of who they're working for. So it's just them putting out more information to the market where they might not have like leverage even to do so. Like, why would they do that?
Yeah. Yeah. No, I'm excited with all the things that they said about the tech platform, but I don't even think it was just a conversation about the tech platform. They brought up a lot of things with financial services and stuff that caught my attention. Like they were talking about a large increase in their interchange revenues and debit spend and all this stuff. So what's really exciting from the financial services perspective of the company, all of the money, like all of it, comes from their checking and savings account. Okay. If now they're starting to see that their direct deposits are now leading to much higher and higher spend, and as a percentage of how much spend that they're getting from that is also exceeding, right? They said average revenue per user has exceeded our expectations, all of these things. It's really going to compound how much higher these margins are going to come from the financial services side of the business, let alone if they start turning around credit card and invest products. They still like the invest product is a profitable business. It's just that they're paying off large amounts of fixed costs that they're still paying off. So, as time goes on, these are only going to increase their margins. And I just think, where SoFi has guided for their margins to go into the future versus where it is today, there's going to be this continuous compounding of growth on top line, growth on bottom line, and then also trying to bring as much of that even further down to a GAAP net income. And just, I don't know, this is the perfect setup for a growth stock of where we are today versus where we're going. And it looks to be like a long trajectory ahead.
So one thing I want to add to that is that, of financial services, we know that credit cards is the laggard in that group. We know that credit cards is not really where they're making the majority of their growth or the majority of their money. And obviously those two are correlated, right? If they're making money hand over fist, they would pump that way more and vice versa. And so that growth has to come from somewhere, and it's going to come from money, essentially. And it's interesting. I might have misheard this, but I even wrote it in the chat as a note. Did he say we're expecting 50% CAGR for financial services through 2026, meaning that
that's what I heard.
It's compound annual growth. And so when you think about 50% CAGR for that lending segment or for that financial services segment, and the fact that, credit card is sort of like a what do you call it? Like a nail in their shoe. It's got to be money. It's got to be these other like Relay in terms of the members. Like Invest is not doing that great either, and so really money is just carrying the rest of that segment on their shoulders.
Yeah, I think if I remember correctly, and people can correct us in the chat if I'm wrong, but it was a 50% CAGR to 2026 for financial services, 25% CAGR for tech platform, and 15% for lending is what they were expecting. And that can change.
He basically said.
Go ahead.
Sorry, I think I have a lag. So he basically said 20% technology growth this year, and then 25% CAGR through 26. So they expect an acceleration. And then the other interesting point was a re-acceleration in lending starting in 25, 26 after the election, right?
Yeah, well, and for people to just understand what a compounding annual growth rate is, if you're expecting 20% this year and then expecting 25% for the entire duration, that means that you're going to have to hit the 30+% to bring that 20 up to 25% on average, like averaged across the multiple years. So, yeah, they are expecting large amounts of growth in the tech platform. This will probably stay around 30+% margins because they've, completely converted from on-prem onto cloud. A lot of the things are kind of set now. It's just like even Chris Lapointe brought this up. It's just about brand awareness now. Just getting in the door and people knowing what we have to offer. So yeah.
Yeah, and the other thing I'll mention is that don't forget, he was asked multiple times about the guidance, and both times he basically acknowledged that it's super conservative, and he said, yeah, we're not going to change it because anything can really happen. And so when you look at these aggressive numbers, you might think, oh, wow, 50% CAGR for financial services, 25% CAGR for, lending, tech platform. That sounds really aggressive. It's even more impressive when you consider the fact that this is the conservative end of the guidance that they're providing. And if the macro is more favorable, then obviously these numbers are going to be bigger.
So one thing that I took away that actually, Tanner's got to be a bull. Sorry. I did hear one thing where they said, hey, what do you see for your outlook on the lending side? Like if things change in the macro or potentially you guys get more comfortable, will your outlook for lending growth change? And he said, and I quoted him here, an awful lot would have to change for us to change our view on origination growth. An awful lot. That's not the greatest sign considering they want to really slow their lending down. But, it is a bank. You have to play it safe in certain areas. They can you can get yourself really caught up in a mess if you play, one way when you're supposed to play the other. So, they said going forward, they're going to stay above 14% risk-based capital ratios, which is, a comfortable area. We actually just turned around. We were 14.5% in Q3. We actually went up to 15.3% this year, playing it a little bit safer. And they're saying, hey, we're not really going to continue to dip so low. So that's not going to have to be a worry. Kind of killing those bear thesis continuously. Anything else, Tevis, that you potentially heard or really enjoyed before we go on?
I think the main takeaway that is going to be pulled out from the retail crowd is just the fact that it's a top 5 bank. I think that was something, I don't know that he meant to do that, or that that sort of just slipped out instead of saying a top U.S. bank, saying a top 5 U.S.
It
bank.
was top 10 before.
But yeah, I mean,
It was
well,
top 10 because I
it's
remember a bunch of people thought that it was going to be Truist. And now it's top 5, which completely cuts out a lot of those regionals.
So do you think that's the same bank that they were talking about, or do you think that they have a top 10 and a top 5?
The fact that they've completely got from, like proof of concept and now they're finished. I think it's the same one just because there hasn't been enough quarters for like a complete test to be finished. So I do think it's the same one. If it's 2 different ones, I mean, holy. But yeah.
I think what I'll end on my end is that this was one of the best firesides that we've heard in recent history because the questions were so good. I mean, the questions were stuff that we would ask, and we go 10 layers deep into this company. And it was even more impressive because Chris sounded so confident, like he sounded like a CEO out there, less so like a CFO. He just sounded. He had this ability to really sort of bring it down and actually say, okay, this is why this is important. This is why this is happening, and dumb it down for all the listeners as well, instead of just regurgitating the same numbers, adding the context as to why those numbers are important. And I think that was, I mean, I mentioned it to the chat. I was saying, like, he really sounds confident right now, and I don't know if you want to read the tea leaves, but that makes me more excited.
Could I add just one more thing, because or maybe 1 or 2 more things, just because these were kind of important, because I just remember them. He asked what percentage of the actual deals that you're engaging in are actually leading to RFPs, which is essentially getting to a point where you're competing with other businesses to win the contract. He said, the majority, large percent of them are going through RFPs, some of the larger names. But what he did say was that they are competing against the legacy incumbent players, which to me, I think of Citigroup, JP Morgan. They actually do have payment services as well. They're actually, the 2 largest really in this sort of debit processing space. But he didn't really talk about some of the smaller names. Like he didn't say any of like no Marquetta or anything like that. I didn't get any of those sort of names come to mind whenever you say large incumbent players. You really think of the large institutions. And then what he said on top of that was these companies are coming to us to replace their homegrown solutions, which means this is the opposite of something that's becoming a commoditized product, right? Companies do not have a solution that they can build in-house that's replacing the services that Galileo has to offer. It's actually quite the same, or quite the opposite. Like, companies thought they could, realize that they're underperforming, and now they're backtracking and finding a modern solution. So, that leads to a ton of potential, in my opinion, if that's the way that the industry is going. Anything to say on that while I find the next part, and then we'll wrap?
Oh, absolutely. I think the thing to mention is that every subsequent acquisition that Galileo makes into that consolidation of the tech platform further widens their moat in terms of making it more anti-competitive for anybody else in the space. Like, Galileo itself might have a few competitors. Technisys itself might have a few competitors, but the combined Galileo Technisys entity and product offering doesn't have competitors, right? Because it's so catered, and especially when you consider that, again, we are moving, it's like that old thing, like if you're building an accounting system, like, what is your biggest competitor? And people say, oh, well, it's QuickBooks or this and that. It's like, no, it's pen and paper. And because that's the paradigm that you're essentially trying to move away from.
Sure.
And that's the same thing with the legacy banking space. Like, they're all on these such old platforms that they don't have anything that's out of the box. It's not like, oh, I'm moving away from this system to go on to Galileo or vice versa. It's Galileo is changing that entire paradigm. And that's the thing that's most bullish, is because, it's a winner take most type of market.
Saw a comment that just says Tevis looks like an angry middle school kid. Sorry to just kill all the financial talk, but that really got me. Yeah, I think that we can wrap there. I mean, tech platform, geography, they're now in 11 different countries that they're trying to compete in. And one of them, people were talking in the chat saying, you know, SoFi or Galileo is now in Canada. They've been in Canada for years and years and years. So they have a client called Coho, you know, these sorts of things. So
Did they have Neo or no?
no.
Did
In
they have
fact,
Neo?
Neo is their own service. We're going to get into a different story, but Neo is actually would be a competitor to Galileo. They're now picking up their own brands and working with them. Anyway, I think that once Galileo actually gets a credit platform, this will be an unbelievable story. The fact that they're only dealing in debit processing still is to me the only problem that Galileo has. But yeah, thank you guys.
I just like that it's getting talked about more. You know, there's no fireside chats where Galileo gets mentioned, and it's like, oh, like what is the net interest margin? You know, what is the lending sales? Did you guys sell any loans? Like all this shit. And it's like, I just want to talk about the technology platform, and now they're reiterating again, 2024, 2025, 2026. So again, look for those patterns of how they're talking about stuff. The initial patterns that we found in early 2023 was Noto saying, oh, we're going to be a top 10. It's a matter of when, not a matter of if. Number one, he said profitability by the end of the year. Number two. And so these are the things you have to look for. Like, what are the things that they're repeating time and again? And what are they on the same page about, right? So the stuff that we heard in the earnings call is just being sort of reiterated now in this fireside chat. And we're seeing a better distribution of questions across their different segments because we're going to see a better distribution of revenue across those different segments. So it has to be corresponding to what the business actually does. And so the conversation is going to divert a little bit away from lending, and it's going to be a little bit more focused on technology and financial services and 3 years out as opposed to just next year. And I think that's a very important point because that's exactly what the market needs to hear consistently to understand the long-term thesis of this play.
Think about the firesides for a sec. The actual bear cases for SoFi, a lot of it had to do with their lending side. A lot of it had to do with the actual banking side. You saw people on Twitter like IP Banking Research that were kind of picking apart a lot of these cases for SoFi. Now all of them have disappeared, right? And same thing for IP Banking Research. You know, they're now saying, hey, like it's up to the tech platform to really realize this valuation. So I honestly think throughout 2024, the conversation is going to shift to what is Galileo doing? Because all of our questions have been answered about the bank.
Yeah, and like, look, how many questions or how many times do you want Lapointe and Anthony Noto to repeat top 5 US bank before somebody like Gary Gordon doesn't assign a $0 value to the tech platform? Because that's the thing that's going to change his thesis from a strong sell to maybe a hold, right? And I'm just saying, I'm not picking on Gary. I'm just saying it's emblematic of so many of the Wall Street analysts. They set price targets on what they can project and what they can understand. And what they don't understand or what they can't project, they just put a big fat zero. Yeah. Nothing with regards to that potential because it's CYA. It's covering their own ass.
Sure. Yeah. No, I mean, and that's fair. Ladies and gentlemen, that's it from me and Tevis. If you want to see more SoFi content, you can go through our channels, browse. Gary Gordon is an interview that I recently had with the man. He sounds exactly like Jack Bogle, which someone pointed out, and I can't unhear it. But anyway, thank you guys all so much for watching. Really do appreciate your time. Bye for now.
Thank you.